Let's start with these numbers. You've said some very provocative things about where the market is right now and where you think it's headed. We'll get to all that in just a minute, but your reaction to these numbers?
Well, first of all, this is August numbers. We're one day away from October.
Good point.
I haven't looked into the details of the number. We pointed out that the way these indices are constructed, that housing costs are very lagged, and they're going to continue to go up, even though, as we saw, the Case-Shiller Housing Index and the National Housing Index, housing prices are going down. So a lot of these indicators are lagged in their incorporation of inflation, particularly in terms of housing. I have to disagree with Rick about year over year, because that contains 11 months that we already know. I mean, the Fed has to be forward-looking. They have to look at what's going on in the market, in the housing market, in the rental market, in the commodity market, and in the other markets.
Jeremy, you've talked about this potentially being a buying opportunity, yet we've had Katie Stockton on, who's been right about these charts thus far. She says there is still more to go here on the lower end. Rick Santelli obviously has that same view. A lot of folks have that view. Would you buy now? And is the thesis of buying now rely on the Fed easing up in a way that they may not even know that they have to yet?
If you're a long-term investor, I would absolutely buy now. I think these are absolutely great long-term values. Could it go down more? Of course, in the short run. In bear markets, it's gone down more. But when you're talking about 16 times earnings, and even if they're clipped by a recession, and you shouldn't just base it on recession earnings, you should base it on longer-term earnings, which I think are very favorable looking beyond the dip. I think these are just absolutely excellent values. Short term, I mean, anything can happen on the short term.
Jeremy, long term, a lot of people would consider 10 years to be a very long term. Stan Druckenmiller told Joe at the Delivering Alpha conference this week that you could be in a position where the major averages are flat 10 years from now, just because of what he thinks we may have to go through between now and then.
I disagree with that completely. That the Dow or the S&P would be flat. I mean, we added 40% to the money supply since the pandemic began in March of 2020. Earnings have historically moved up just with inflation and the money supply. So stocks should be 40% higher than they were. Now, they were at 55% higher, and now they've come down. I guess they're 20% higher than pre-pandemic levels. So to say that, 10 years from now, we're going to have the same Dow when the earnings yields that I see there on the market show that your returns are going to be probably in the neighborhood of 6% per year after inflation. That's a bit below the long-term average, but still much better than bonds, and certainly far above a flat average.
When some people compare this and they say, look, the last 40 years, if you look at the last 40 years as history, you'd be 100% right, Jeremy, that, you could hold your breath for 6 months, a year at any point, and when things are bad and you wake up and everything will be great again. But then you go back to 1970, and I know you don't think this is 1970, but you had to wait a decade, at least. What's the difference?
Well, you had a way to, you take 1970 as a peak. I mean, some people, told me, well, what happened from 2000, which was again a peak? We're down 25% from that. At least, and obviously on NASDAQ, you're down more. So you're not starting from a peak. And you're also, at that peak, you were not starting at levels that, to me, were, particularly overvalued. So you're starting from a position where I think, now, certainly not the cheapest that we've had, but certainly the economic circumstances are not that it's Jeremy, negative at all.
Shepard Smith here. Thanks for watching CNBC on YouTube.